Let's talk about different types of stocks. Certainly, younger people think, stocks, I need to do that, because I can achieve super high returns with them. And in a certain sense, that is true. But what turns out is that a lot of people simply lose money with stocks, or they achieve a lower than average return. You must always be objective. What is the benchmark? The benchmark is the average. And if you can achieve an average return with ETFs, just as you can with real estate or other investments, then the only reason to deviate from that is to achieve a higher return, or the same type of return with lower risk. Now, investing in stocks is a way to either achieve lower risk or realize higher returns. However, you must do it the right way. And of course, there are different types and kinds of stocks that you need to consider, and that is what this video course is about, providing an explanation of what we actually use, namely 3 different classifications: value stocks, dividend stocks, and growth stocks. First, let's take a look at stocks in general. This image is actually a nice summary. We can look at company size. That is the company size. And within that, we actually see 4 different types of designations. A microcap actually refers to a small publicly traded company. It typically concerns the market value. The market value depends on financial metrics. We will not discuss that here. We will not cover determining financial valuation based on the price-to-earnings ratio, also known as the PE, the price-to-earnings ratio, or the price-to-sales ratio, the price-to-book value, and similar matters in this video. We will only address that in the advanced courses in the Happy Investors community. Depending on which module you have purchased for yourself, it may or may not be included. If you have any questions about it, feel free to ask us and we will help you further. But here in this video, we are simply going to talk about the different types of stocks and what impact that can have on your overall strategy, as well as a bit of risk awareness regarding that. Now, microcaps have a market capitalization of around less than 300 million, a small cap, and a large cap is above 10 billion. Meanwhile, there is also a category called megacap, which is, above 100 billion, to add to it. And then there is also a category called megacap, which is, above 100 billion. And then there is also a category called megacap, which is, above 100 billion. The essence of this is that a large company, so for convenience the large cap stocks, has become larger over the years for a reason. They have a well-developed earning model that know how to make a profit. Sometimes they even have higher profit margins. So this refers to a quality company, and the risk of such a company is usually lower when investing in it. Well, they have a well-established market position for a reason, and they are also easier to analyze because of that. Based on analysis, you can actually determine with more certainty which direction a company might take, and you can also more easily estimate the price development based on the financial matrix. A small cap company is a different story. A company valued at 500 million. This company can have a revenue of 50 million, but this company can also have a revenue of 500 million. It all depends on the valuation, what one is willing to pay for it. And that all depends on future expectations. Is this company going to grow super fast? Or is this company actually in trouble? There are even stocks that have a market value of, for example, 1 billion, of which they have 600 million in cash. In other words, 60% of the share is simply cash value. This means that you have a relatively low risk. There are many different stocks, but in general, a generic rule is that the smaller the stock, the more volatile it is, the higher the risk it inherently contains. Why? A small company can indeed be outperformed by the competition. Its business model may not yet be well developed, and it may turn out that it is not justified for it to have a certain valuation at all. In other words, the company was just lucky for a few years, and is now facing poor economic conditions, which could lead to losses. So there are many different types, and the smaller the stock, usually the higher the risk, but also the higher the potential for price growth. We primarily look at the type of stock, such as in terms of various aspects of value, different dividend, and growth. A diversified portfolio with stocks, let's say you have 20 or 50, means that you not only have companies from different sectors, but also companies of various sizes. For example, if you have 100% in terms of money, you would want to allocate a larger percentage to large cap stocks as you approach your retirement. But imagine that you are young and you have advanced knowledge in analyzing companies at a fundamental level. That is, determining the strategy and potentially a sustainable competitive advantage. Yes, then it might make sense to look at small cap and mid cap companies, which are relatively smaller and show a lot of growth. If we go back to when we are older and approaching retirement, you would actually want to take a more significant position in dividend and value stocks. So it is very important to understand what these different types of stocks entail and how you can actually engage with them. Depending on your situation, including your risk tolerance, age, and wealth, all of which are important factors for your choices within a stock portfolio. And that relates to the aspect of volatility. But for example, you have touched on blue chip, which is a piece of volatility. That 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 is a piece of volatility. A well-known term actually refers to companies that are already very well established and recognized. We see 3M, we see McDonald's, we see Bank of America, we see the Coca-Cola Company, and such a blue chip stock. It's nice to look at this picture. It includes value stocks, dividend stocks, and growth stocks. For example, we see Microsoft. Microsoft is essentially just a growth stock, a company that consistently grows. Okay, they are currently paying out a small amount of dividend, but essentially it is a growth stock. We also see value stocks. For example, Bank of America is a value stock. I will explain what that means shortly. AT&T is, for example, a dividend stock. It is a company that actually pays out a very high dividend, around 6 to 7%. This example will come back shortly. You also have penny stocks, which are actually stocks that, according to me, are under $10 or under $5. I'm not exactly sure. These are actually very volatile stocks, so they can rise very quickly in a short time. I would just stay away from them. But everyone for themselves. There are also cyclical stocks. These are stocks that, primarily in industries like semiconductors or commodities, go through a certain cycle. Sometimes things go really well, and they receive a lot of orders. On the other hand, things can go very badly, and with commodities, you often see those cyclical movements recurring. Advanced investors can certainly start to profit from those cyclical movements. From our experience with beginner investors, it is often the case that people enter at the peak of the cycle, when those stocks have already risen so much. People only start to believe that it can rise further at that point, but then you're actually too late. You buy too late, so you buy too expensively. And many value stocks are actually located at the bottom of the market. That is interesting. It will come back to this shortly. Well, why then invest in stocks with all these complexities and all these choices? Yes, those choices also provide, how should I put it, a certain degree of freedom to arrange things, which is quite enjoyable, but essentially you could achieve a potentially higher return than an ETF that aims for an average. And in parentheses, it states that stocks average 11% compared to 8% for an ETF, and that 8% refers to the S&P 500, and that 11% for stocks is particularly when talking about large cap stocks. For small cap stocks, the returns can even be slightly higher. But everything depends on your selection, your knowledge and skills, and the level of analysis you have conducted. And there are very advanced investors who buy only 10 to 15 stocks. Often, the largest portion of their money, for example, 20% of the total amount, is also invested in just one stock. But yes, those are the advanced investors, and they spend a lot of time and energy following all those companies. Ultimately, that is the way to achieve really high returns, so they call it focus investing. You select a limited number of companies, and that is actually the personal choice for myself as well. You only buy truly high-quality companies. What is a high-quality company? For example, a Coca-Cola company. It has a highly diversified position, an incredibly strong brand name, and an unmatched distribution chain. They even return a bit to the shareholders, but that's not the main reason. They also have a sustainable business in terms of high profit margins and a high return on equity. These are all terms that make you think, wow, what is all this? I'm here for retirement investing, or I'm here for, ETF investing. It can all be done, but yes, just know that stocks are super great, but you do need to have some knowledge about it. This is just an introduction to different types of stocks. As I mentioned, in other courses we will go much deeper into how you can benefit from them. And of course, we make our own analyses, we call them, where the stocks, the happy value stocks, the happy dividend stocks, and the happy growth stocks. It's super fun, and we have advanced by now. We also achieve quite good real estate. Of course, when we select 100 stocks, there will always be a number of stocks that do not perform well. In fact, there will even be some that perform dramatically poorly. However, it is about the average of those 100 stocks, to give an example. And that is also the case with stocks. There is also a greater chance of price loss. So if you simply buy a stock based purely on its name, then it is quite possible that you are paying too high a price for such a stock. Go to our website, businessinvested.info. You can find our own track record of money invested and our performance. Then go to Free Investing Tools, where you can download a lot of free investing tools. Stock portfolio tools, stock calculators for intrinsic valuations, and also free investment ebooks, ETF investing guides, stock investing guides, and more are coming soon. Well, let's first take a look at value stocks. After that, we will look at dividend stocks, and finally examples of growth stocks. Value stocks, I am intentionally using the term value stocks. In English, it is often referred to as value. But the essence of value is actually that the stock price is below the future intrinsic value. A diagram I created that illustrates this shows the stock price. And here we have over time, this could be a few months or weeks. Usually it is also a few years. And what do we see? This is the price, this graph here. And we see the yellow line, which is actually the intrinsic value. And the intrinsic value means what the company is actually worth. It is already difficult to determine what a company is actually worth. That is, its intrinsic value. That is already difficult, and it is also challenging to determine whether the price is below or above the intrinsic value. What we see is that with a value stock, you want to buy at a moment when the price, for whatever reason, has dropped sufficiently to be below the intrinsic value. For example, a company has 10 production facilities, and if the company were to stop today and sell them, they would be worth 100 million. The price, however, is at approximately 70 million in market value. Then there is a gap of 30 million. The term margin of safety refers to the difference between the intrinsic value and the market value when it is undervalued, and the larger that gap, essentially, the lower the price is below the intrinsic value, the higher the margin of safety. This means that if your analysis is off, you still have some assurance that you can achieve a return. And essentially, in fact, any stock can be a value stock. Because even growth stocks sometimes have periods where the price declines for any reason. For example, if they have poor quarterly results 1 or 2 times in a row, confidence wanes for whatever reason, or there is a lot of bad news, the CEO leaves, blah blah blah, and the stock price drops by 50%. So much so that it can fall below the intrinsic value. And that intrinsic value can also be yours in 5 years. That is, of course, the whole trick. Well, at that moment, you buy, so you buy below the market price. And that is essentially a value stock. And this also means that because you buy below the intrinsic value of a company, you have a lower risk. So, value stocks offer a relatively lower risk, but still provide a potentially higher return compared to ETFs and index funds. Therefore, value stocks can be super interesting for when you get older and have more capital. If you are approaching retirement or are simply around your 40s or 50s and already have a lot of money, value stocks can be very interesting for advanced investors as they are somewhat more short-term. Think of 6 months, but it can also be 3 years. And when you see a really great opportunity, you buy now below the intrinsic value. And after 6 months, it can recover itself. The market realizes, hey, wait a minute, this company is actually worth more than I thought, and they quickly buy in, causing the price to rise relatively fast in a short period. We also see this reflected in our happy value portfolio, which is an example of stocks we buy for their value. We will take a look at that shortly. But first, let's discuss a bit more about those value stocks. You recognize it in principles. I'll just mention it. Usually a lower PE. The ratio, so the price to earnings, means the price earnings ratio. Usually lower, think certainly below 15, but often even below 10. And that is indeed extremely important because it is very difficult to do. We often see a lower earnings growth. So a lower earnings growth, the profit increase and such is relatively low. And what is also true for stocks, value stocks, is that they do pay dividends. But it is usually the case that they pay a slightly higher dividend than normal. Just because the price has fallen so much, the dividend payout relative to the price is relatively high. And usually value stocks are really more suitable for advanced investors, as you need to be able to conduct a good analysis to determine that the company is truly undervalued. If you are wrong and fall into the value trap, you are simply buying a bad stock. Since any stock can be a value stock, it also means that poor companies can be value stocks. And if your analysis is incorrect, then you simply buy a lousy company. Yes, and you end up with bad stocks, so you don't want that. Value stocks are suitable for both young and old. That's nice. Even if you are retired and willing to lose that money, but you naturally want to achieve higher returns, that can still be done with value stocks. Well, here we see an example of the happy value portfolio when we established it right at the beginning. What does that mean? We have actually just set up a kind of example portfolio, and we have consciously chosen to only buy value stocks and dividend stocks. Well, there are also a few good stocks in there, but for example, you see the Mossack company, which was in a relatively short term. I think it was about 4 months later, and it was around 40%. And this is just a very simple company that produces fertilizer. Okay, it's a big company, they have a distribution chain, blah, 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 but it's not like you think, wow, this is really a unique company. The same goes for Scorpio Tankers, a shipping company, which is not spectacular at all, yet has achieved a relatively high return in a short time, namely 30%. In this case, you see that there are a number of stocks that are not performing very well or are performing poorly, but a few stocks are not doing well. So actually not many people can recount that you have such a good start. Fortunately, we can. Meanwhile, Merck & Co., which is a dividend stock, has also risen further. But there are many different types of stocks. And if we talk a bit more about value stocks, for example, what we see is ON Semiconductor. Well, this company has actually underperformed for a long time. If you had bought an ETF, you would have had a much higher return 20 years later than if you had bought shares of ON Semiconductor. But lately, and we mentioned ON Semiconductor somewhere here, even before it peaked significantly, the company has developed more, but the financial valuation was relatively low. So the PI ratio was just slightly below 15, while the growth expectations were quite okay. This means that the price was likely below the intrinsic value. In this case, we were right, and we see that the price is rising. Well, an even better example of a value stock in this case is Pampa Energia. Coincidentally, it is also a stock that we have categorized under the happy value portfolio, but also as a happy value stock report. If we bought somewhere here, it has already increased by over 100%, but we see that Pampa Energia, if you had bought that at the beginning of its introduction, you would have been up a little more than 10 years later, but not by a huge amount. 200% is roughly 3 times, so 10,000 euros would have become worth 30,000 euros. Sounds like a lot, but over the 20-year period, it's not really that much. However, you can see in the meantime that it has also dropped significantly, then it rose enormously, and then it dropped hard again. So Pampa Energia is actually an example of a cyclical stock. I happen to be in utilities as well, which is more on the commodity side. Yes, that's just more cyclical. So a value stock is something you want to buy at a certain moment, and that is actually the classic definition of a value stock. When no one is looking at this type of stock, when it is actually hated, the sector is worthless, no one has any confidence in it, and the price has dramatically fallen. Yes, that could very well be the moment when you want to buy. So you buy very low at the beginning of a new cycle, when the market for that specific company starts to become attractive again. And then you buy low and sell high. This is a nice example of a value stock. Another example of a value stock in this case is a bank, Unicredit, which we have nothing to do with, a bank in Italy. If you had bought shares at the beginning of the price in 1995, you would have seen your shares down by 50% 30 years later. This time the dividend is out, so that might have been adjusted, and of course you also have inflation that affects it. But here too, you see periods of low prices, then suddenly a significant increase in a relatively short time. Then there is another sharp decline, in this case due to the financial crisis. Yes, quite relevant for a bank. And now it seems to be dragging a bit. So the question now is, at this moment here, hey, could a new cycle be coming in which this bank can grow into a large company again? Look, if you have that kind of knowledge, macroeconomic insights, you can become a good value investor. Let's take a look at dividend stocks. They are actually a mix between value stocks and dividends. Now, a dividend stock can essentially be a value stock or a growth stock that happens to pay a dividend. The only main distinction with a dividend stock is that it is a stock that actually pays out consistently more dividend. And more dividends, that's what it's all about, and also consistently. So we have stock analyses, and we call them happy dividend stocks. And we actually analyze that based on companies. Companies that have a good financial valuation, future growth, somewhat acceptable price momentum, but especially those that have good dividend payouts. Ideally, they should have years of consecutive dividend growth. I just have a girlfriend. And I have a girlfriend. And I have a girlfriend. And I have, for example, 500,000 in assets. And you have, for example, a 5% dividend each year. Then that is still 25,000 euros per year. After deducting a tax, you are left with 20,000 euros, which you can partially use to buy financial freedom. The level of dividend yield, which is the dividend payout, is of course important. This little example, this image we have with Microsoft, serves as an example of the 1% dividend. If you want to receive $500 or euros with a 1% dividend, you need to invest more than 50,000 euros in it. But if you were to invest that same 50,000 euros in AT&T, which pays a relatively high dividend of around 7%, so for the same amount, you want to take out, namely that 500 euros in dividend, you would need to invest about 7,000 euros. So you need to invest a much smaller amount to get the same kind of dividend out of it. I just mentioned as an example you had 500,000 euros and you had a 5% dividend. If you achieve a 10% dividend, then you have of course 50,000 euros in income per year. A 10% dividend is indeed very high. That is not realistic, but you can create a portfolio consisting only of high dividend stocks and have around 7 to 8% dividend. Of course, there are also disadvantages, such as generally having lower capital returns as a result. Why? Well, those companies pay out a lot of dividends, so the money they distribute as dividends cannot be invested in their own business. So often we see that companies that pay a very high dividend apparently do not see an opportunity to invest that money profitably in their own earnings model and achieve profitable growth. So they choose to distribute that money as a dividend to please the shareholders. Some companies also cannot go back, as they have a history of 20 years of payouts. And shareholders naturally also demand dividend growth. So yes, it's a bit like they are stuck, so to speak. But well, that's another story. Well, those dividend stocks actually provide a high degree of certainty for dividends. And our tip is to let the position in dividend stocks increase as you get older. And that is also one of the reasons why I make such videos, because that is one of the reasons. Actually, it is even better to invest in ETFs. Making these videos allows me to share valuable insights and information with a wider audience, helping them understand the importance of financial literacy. Investing in ETFs is beneficial because it offers diversification, lower risk, and potential for steady growth over time, making it a smart choice for many investors. Bond ETFs, stock ETFs. We talked about that in the choice of pension investing, but here, it specifically concerns stocks, and the essence is that dividend stocks can carry a lower risk than good stocks. That is the essence. And of course, you can consistently reinvest dividends. Some stocks pay out dividends monthly. Most do so quarterly, so every quarter. I still remember what the word is, by the way, quarter, but every quarter. Others do it every 6 months, and some once a year. But you can, of course, reinvest that dividend in your portfolio. And this way, you let dividend grow on dividend. Well, of course, dividend stocks are also super interesting for young people. Why? You can indeed beautifully achieve the concept of financial independence with that. If you have low expenses, meaning your lifestyle follows a certain spending pattern, and your income is much higher than that, then you have freedom. And you can, of course, increase that income thanks to, for example, dividend stocks. By receiving dividends on stocks, on real estate, etc. Absolutely beautiful. And that's why many people often choose dividends. I must say, dividend growth stocks are super interesting. For example, these could be a McDonald's, or maybe a bit of a Microsoft. These are companies that grow every year. Profitable growth. But they also increase their dividend every year. That is, of course, super interesting. Then you have both dividend and capital gains. Now you also see those happy dividend stocks for more inspiration, and we rank them based on valuation, so the value, but also on the dividend score. And for that dividend score, we look at what the dividend history is, so whether they have always paid a reliable dividend, what the dividend growth is, whether the dividend has increased every year, what the dividend security is, etc. An example of a great dividend stock is PepsiCo, Inc. If you had bought shares at the beginning of its stock listing, you would have seen a capital return of 9,000% many years later. That's a lot of money, such as a small fortune. PepsiCo pays out around 2.5% dividend. It has been paying dividends for many years and also increases its dividend every year. So this is really a classic example of a dividend stock. Of course, Coca-Cola as well. Another example is Caterpillar. I find this interesting to mention as an example, because Caterpillar is actually a good dividend stock. It has been paying out dividends for many years in a row. Let it also grow every year? So it is actually a great dividend stock. But you can see that there is quite a bit of cyclical movement in this stock. Caterpillar naturally supplies to, how do we say it, cyclical domestic markets. So mining companies and that sort of thing, infrastructure. You can also see that cyclical movement reflected in the stock price of Caterpillar. This means that there are times when they make less profit and then the stock price drops very sharply. They pay out some dividend, but the stock price also declines significantly. So this is yet another example of a more volatile stock and is not equally desirable for everyone. But an advanced investor who thinks, hey, interesting, it has dropped 30%. I will buy at that moment. Actually, Caterpillar is essentially a commodity stock that just happens to pay a dividend. Do you get it? So those different types of stocks, the classification gets a bit mixed up. And as you start to feel more comfortable with it, you begin to see beautiful patterns and opportunities to achieve above average returns. For those who bought at the right moment, they naturally had a much higher return than someone who employed a buy and hold strategy in this case. AT&T as the last example, an example that actually shows both the advantages and disadvantages of a high dividend stock. AT&T has been paying a very high dividend in recent years, around 7%, but apparently its business model is not performing very well. If you had invested in 2000, you would have simply faced a significant loss 20 years later. At your expense, yes, you can receive nice dividends, but you also have capital losses. So, that dividend really needs to be high enough to compensate for those capital losses. Otherwise, it's not interesting, of course. So AT&T has likely had a lower than average return compared to the S&P 500. I must honestly say, I have not verified this over this time period, but the chances are high. And if that is the case, then you would have actually been better off investing in the S&P 500, because then you would also receive a small amount of dividend, but you would have also gained much more in capital appreciation. In other words, on average, you would have achieved a higher return while also having much more risk diversification. Because you invest in an ETF with 500 stocks, while AT&T is of course just one stock. Hey there, very quickly, my name is Jorik Vermeulen. I have over a decade of investment experience and also in entrepreneurship. I have my own company called Happy Investors in the Netherlands, and we share information about investments in the stock market, including the S&P 500 and various other index funds. Through this channel, Business Investor, I share a lot of knowledge completely for free, no questions about anything. But I would really appreciate it if you would subscribe, follow, and share the videos with your friends, because my only goal for this channel, Business Investors, is to help you achieve financial freedom. Finally, the last category is good stocks. In a nutshell, growth stocks are companies achieving significant future profit growth. The key is profit, because yes, you need to realize profit. Just revenue growth is not sufficient in the long term. I find it a super fun picture. Play long-term games. Personally, I am very inclined towards growth stocks. My wealth is now increasing, so I would also like to receive more dividends. I believe in buying high-quality companies that consistently achieve significant and sustained profit growth over the long term, with a profitability, a return on equity that should actually be above 15%. This way, you can really achieve a higher return than average. It doesn't always work out naturally, and you need to have a lot of patience. The volatility can be higher, and there are times when such a stock is down 50%, but play the long-term games. Playing in the long term usually yields exponential results. This applies to investing. It applies to entrepreneurship. It applies to reading 20 pages of a book every day, from knowledge books. It applies to following a short video course every day. Small habits in the short term that you maintain for the long term, based on a long-term vision, and then really believe in it and work towards it. This usually provides exponential returns. Or in terms of stocks, the advantage is compound interest, compound interest, compound interest. This means that growth stocks, classically speaking, can achieve a high return on investment in the long term if they fulfill their growth potential. That is, of course, very interesting. That is why we always engage in long-term investing, as it usually provides the highest returns. The downside of good stocks is, of course, that they carry a higher risk. In some cases, a much higher risk even. Certainly when we talk about small caps, we have discussed that relatively smaller companies with a lower market value. But large cap stocks can still be growth stocks. Microsoft has a huge market value and is still a company that, I think, achieves at least above 15% annual profit growth and revenue growth. And that is essentially just a growth stock. So there are again different types and sizes, which makes it really fun. Now, expectations versus reality. Everyone thinks, oh yes, I'm going to invest in growth stocks, and then I'll have a hockey stick in so much time. The hockey stick is that the price increases exponentially. What it definitely is not is a linear increase. Never, ever. It always goes with ups and downs. Some people start well, but most people start poorly. They buy when a stock has risen very quickly. The best investors really buy high-quality growth stocks when they have a good financial valuation. This often happens after a significant price drop or when people misjudge what this company is actually doing. The reality is, and this comes up often in this picture, that it goes with gentle movements. This is true for everything in life. We have good moments, and we can be assured that during very good periods, less good periods will also come. The opposite is true. In very bad periods, we can be assured that good periods will also come. Keep believing in that. Therefore, invest exclusively for the long term in good stocks. We say at least more than 5 years. But the best real estate is held for 10, 15, or even 20 years. And you shouldn't underestimate that. It's a very long time. It may seem obvious, but I have been doing this for over 9 years now, almost 10 years. Try holding stocks for that long. It's not a given. I must say most people on average have almost no discipline. We would like to have short-term results, while good stocks and the best outcomes are actually achieved by investing a lot and having a lot of patience, holding on. Well, what is important for good stocks is that fundamental analysis is even more crucial. You really need to have a good understanding of what this company does, what its current strategic position is, whether it has a competitive advantage at all, and if it can achieve a better strategic market position in the long-term future. We often recognize growth stocks by the fact that they have a higher price-to-earnings ratio, higher price-to-book ratio, and other financial metrics. Because you pay a premium for a high-quality company, such as a renowned and established one, And we want to do that because we often see that they have faster earnings growth. So they have faster profit growth. Every quarter again, faster than average. So usually if you see a stock that has a PE ratio of 15 and is expected to grow by 20% in the coming years, both in revenue and profit growth, well, those are golden opportunities. Those are very good stocks. But often you see that a growth stock has a PE ratio of, for example, 25, 30, or sometimes even higher. Well, the higher it is, the higher the revenue and profit growth must be in comparison. What we often see with good stocks is that they pay little or no dividends. The reason for this is super logical. Why pay dividends when you can invest every euro into your own business model, where you can achieve a very high profitability, a high return on equity? In other words, for every euro I invest, I can achieve, for example, a 50% return. Yes, then I prefer to invest in my own business to grow faster. Isn't that right? This way, you also reward your shareholders. Good stocks are therefore especially suitable for young investors. I do not see pension investors always investing much in good stocks. But what you can do, for example, is if you have a portfolio of 20 stocks and you are a bit older, and you have a high level of risk tolerance, so you accept that you may lose a lot of money in the short term. But on the other hand, you still have about 7 or 10 years left. Yes, then you could say, well, I will invest in 15 stocks, for example, in dividend and value stocks, and I will put the other 5 in a few unique growth stocks. Just because you really believe in it, you know the company very well, and the opportunities behind you are rising very high. Well, a few examples of good stocks, of course, must include the company Google. Of course, Alphabet is the parent company. Yes, you can see the development of the cows is phenomenal. What I find very interesting is the second desk. By the way, I own shares in Alphabet, and the second desk, I always have to mention that, but it may be the case at the moment of speaking. Maybe in a year I won't have them anymore. In any case, I do plan to hold both for the long term. Alphabet is a mega cap, so it has a very high value. The second desk is a large cap, so in my view, it still has a lot of growth potential, but time will tell. Another example is Cloudflare. This company rose from around 30 to above 200 in a relatively short time, so that is more than x6. So if I had invested 10,000 euros here, it would have been worth more than 60,000 euros at its peak. But from that peak, from that 200, we also see that it has rapidly, even very quickly, fallen back down to below 50. So that is, of course, the downside of growth stocks. If the growth falls short for any reason, you will see a significant drop in the stock price. And now the question is this justified? Is Cloudflare experiencing a dip due to macroeconomic developments? Or is there something fundamentally wrong? If it's the latter, then the market is correct. Often the market is incorrect and is simply driven by fear. So basically you want to buy good stocks, but that's true for everything. You should always just buy at a good financial valuation. And you must have certainty, or a high degree of certainty, that the long-term growth is realistic. The only way to do that is, of course, to conduct a lot of analysis. Research, research, research. Another example of a good stock is STEM Inc. You can see that in a short time it has risen from 10 to 40, really in a matter of months. And in another matter of months, or actually more than a year, it has dropped from 40 to even below 10. And here at this moment, it is around 3 or 4. So yes, you can also lose a lot of money if you buy at the wrong times, or simply buy the wrong companies. STEM is a very small company. ASML was once a very small company. And this is indeed an example of a very successful story. Did you buy at the very beginning of the price back then, so many years ago? Well, then you would have more than 30%. A 30,000% return. That is, of course, truly gigantic, and every investor actually dreams of that. But yes, you do need to have more than 25 years of patience. So yes. And here we also see with ASML, from the moment you buy until the dot-com crisis, high returns, then a huge drop in stock price. In my opinion, this has fallen by more than 70%. It declined, again, during the financial crisis. So you actually see the same patterns every time. You can always buy high-quality companies at a good price if you have patience. It's not necessary to always buy at the peak. With a lot of patience, you can buy very good companies at an attractive price, but you need to know how to find out about that. What is a good financial valuation? What is the long-term potential? Follow our ongoing courses for more information. We have reached the end of the types of stocks. It is more of an introduction to the different kinds of stocks that exist. As I have indicated, stocks have a relatively higher risk and return profile compared to ETFs, simply because you are putting your money into fewer companies. Well, experienced investors can achieve a significantly higher return with stocks than with ETFs. Not everyone can do this, but there are people who can. And, of course, you can also start playing. An ETF often has an average real estate, so it also has an average dividend. But you can also choose a portfolio with a relatively higher return of 5 to 6% if you want. Well, good stocks are riskier, but they also make more sense to buy at a young age. When you are young, you can simply take more risks. And if you take a lot of risks in the right way, it can lead to better results. If not, at least you still have time to recover from the loss. As you get older, it is wiser to increase your position in value and dividend stocks. This is actually always a wise decision. The older you get, the less risk you should take. So, when are you actually successful with stocks? It's actually simple. By only buying shares of companies that you truly understand based on very thorough research. Often the best investments are in companies where you work yourself, as you are well informed and have insight into the management figures for the coming years. You know that market, and you know the position of your company. You know the financial figures well. Look, if you invest in sectors that you know very well and you can accurately assess that these are actually one or two of the best companies in the sector and you buy those companies, then you will achieve high returns in the long term. Advanced investors invest in about 16 to 25 stocks. There are also investors who invest in 3 stocks, some in 10. There are even those who invest in 50 stocks. There are many choices and types in this regard. It is always important to choose from different industries and to check the status of this company at least every quarter or half year. Do not panic if there is a quarter with worse figures than expected, but do pay attention to fundamental developments. Is the CEO, who happens to be the co-founder or the founder, going to leave? That is a signal. Conversely, the opposite can also be true. Have they developed a new product, or are they investing a lot of money in product development? This could turn out very well. Well, this is just the tip of the iceberg when it comes to stocks. As I mentioned, there is so much to talk about. Super fun. Super interesting. And hey, this is just the beginning. I would say just dive deeper into stocks if you're interested. You can achieve high returns with it, but you need some knowledge and experience for that. Thank you for watching, and see you in the next video lesson.